Hey everyone. Today we're talking about a unique type of financial asset that can add value to your investment portfolio, preferred securities. These have characteristics of both stocks and bonds, which makes them special, but also makes them a bit tougher to understand. Fortunately, I have two perfect guests here to help explain how preferred securities work and how they might fit inside of your portfolio. With me today is Joseph Bozoyan, Portfolio Manager at Manulife Investment Management, and James Gearhart, Associate Portfolio Manager at Manulife Investment Management. Why don't we start with you, James? Can you tell us a little bit about your background and what you do at Manulife?
So I am James Gearhart. I'm an Associate Portfolio Manager on Manulife Investment Management's global credit team. We manage over $10 billion in assets in credit-focused portfolios for clients around the world, including $5 billion in preferred strategies that Joe Bozoyan leads. I've been a fixed income and preferred income professional with Manulife since 2015. I have a degree in economics and a degree in finance from Radford University, a master's in finance from the University of Rochester. I'm also a CFA charter holder. So I worked at UBS during graduate school, generating equity ideas, running statistical analyses of mutual funds and ETFs. I later joined Fitch Ratings in New York City as a credit analyst focused on the media, gaming, lodging, and leisure sectors. And following that experience, I joined the Boston-based asset manager Loomis Sales & Company as a credit analyst focused on the auto, airline, aircraft leasing, and some other industrial sectors. Finally, in 2015, I joined Manulife, where I initially worked as an analyst covering the media, cable, and technology industries. So what's common across all of these roles? I've focused on companies rated both investment grade and high yield, and I've made recommendations to buy and sell securities up and down the capital structure, including term loans, bonds, convertible bonds, preferred equity, and warrants. Last year, I transitioned from analyst to associate portfolio manager, where my focus is firmly centered on generating alpha and managing risk via security selection and asset allocation for clients across the world. So I work closely with Joe on the preferred strategies and also continue to work on our high yield credit strategies as well. So Sumit, before we jump into the deck, do you want to kick us off with a question?
Absolutely, James, and appreciate you giving us that introduction. I think it's best that we start at the top with the most basic question so our audience has a good foundation which we can build on throughout the rest of this webinar. And that is, what is a preferred stock and what types of companies typically issue preferred stocks?
Yeah, great question. Let's start with the 101 here. So at a high level, preferreds are a class of stock or debt that entitles investors to certain preferential treatment, hence the name preferreds. Preferred equity investors have priority claims to payment of dividends over common equity investors and in the liquidation of a company assets over the common shareholders. So if I turn your attention to the presentation, we can see a simplified diagram of a corporate capital structure. And here, preferred securities are shown sitting below the traditional bonds, but yet above the common equities. That's why they're sometimes called hybrid securities. Preferreds will have some bond-like features, including periodic coupon payments, a maturity date, call schedules. They get assigned credit ratings by rating agencies like Moody's, S&P, Fitch Ratings, and they also have a stated par value. On the other hand, preferreds have some equity-like features, including flexible coupons, favorable tax treatment, and there's higher correlation with equities versus traditional bonds. So while preferreds have higher yields and they sit lower in the capital structure than traditional bonds, they are typically issued by higher quality companies with very solid balance sheets and investment grade ratings on the senior debt. And that's really key to this asset class's attractiveness. Back to your question, some of the key sectors in this preferred universe includes financials, utilities, which we're materially overweight, energy, and some example companies would include Bank of America, NextEra or Dominion in the utility sector, and BP in energy. High level, globally, the size of the preferred securities universe is over 1 trillion. A majority of the market is US-based companies, and that's followed by the European market. And that market is dominated by COCOs, or contingent capital securities. So that's the 10,000-foot view on preferred security market. We'll get into some more specifics later on. So I hope that answers your question. At this point, let's flip to the next slide. And we can highlight why we think you should own preferreds, why the John Hancock Preferred Income ETF, and why Manulife. So starting with why own preferreds. As mentioned before, this asset class provides favorable yields, and in addition to that, very low default rates. And that means that the yield you see is sustainable, and that's really key to income investing. Preferreds overall have low duration, and that leads to less interest rate sensitivity, especially relative to investment-grade bonds. So why JHPI? We offer an investment-grade rated ETF. There's a compelling yield on this product. And in fact, as of today, that yield to maturity is over 8%. And this compelling number, it's a yield that we haven't seen in years. We're balanced in our sector approach. We focus on high quality companies with cash flow visibility. We are defensively positioned, but we can also be opportunistic given the breadth of resources we have to pull on. And that brings me to why Manulife Investment Management. We have a deep and experienced team. We're supported by over 35 fundamental research credit analysts, both in Boston, but also around in several offices around the globe. And I should mention too that we have a close working relationship with equity analysts and PMs as well, including our financial industries team. So these inputs are of tremendous help to our team when we portfolio managers go to construct a portfolio. We have a long-term track record. We're one of the largest preferred investors globally, with over $5 billion of preferred assets under management. I think at this point we can jump to the next page. We'll take a look at the quality and default history of the preferred market. That should help to reinforce the notion of income sustainability that I just went over. So on the left side of this page, we have a diagram that shows preferred security and preferred issuer ratings. And within that chart on the left, we have a bar that shows preferred security ratings. And then we have a bar that shows issuer ratings. The issuer ratings are on the right. The left bar shows that the majority of preferreds are investment grade rated, and they're predominantly triple B rated. Importantly, though, that right bar illustrates that over 90% of the issuers of preferreds have senior debt that is rated investment grade. And the majority of that debt is very strongly rated at AA or single A, which again highlights the high quality nature of preferreds. On the right side of the page, we have data that shows the long-term default rate for high yield. It's around 2.6%. We think that's heading higher. And on the right side, we have the preferred default rate of 0.01%. Again, we think it's going to tick up, but we think it will also remain much lower than 1%, which again goes to highlight that these are very high quality securities. Sumit, any questions on your end before you move on?
Yeah, James, I was wondering, obviously when people think high yields, they think of junk bonds and things like that. I know, James, that you manage portfolios that employ high yield bond strategies. How should investors think about preferred strategies as replacements or complements to their existing high yield strategies?
Great question. So I'd say that I view preferreds as a complement to high yield. We view them as a complement to equity or investment grade bonds or any portfolio. And that's because this asset class has unique characteristics that at minimum make it a great diversifier. You just take a step back here and you look at the forest in lieu of the trees. Preferreds offer high yields from high quality companies that have low default risk. Preferreds also have tax advantages versus other sources of fixed income. These are pretty unique characteristics. And Joe will touch on it later in more detail, but our strategy is unique within the category as well, as we provide income. But we also have flexibility and capability to move across the preferred market and also take advantage of periodic security or market dislocations. And that can provide medium to long-term capital growth in addition to high income. So as you mentioned, I'm a PM on our high yield strategies as well. And I would say that my background as a credit analyst, as well as Joe's, it's very conducive for building a portfolio of preferreds. As income-oriented investors in the high yield market, or when we go to invest in subordinated debt that's located far down in the capital structure, as preferreds are, it's essential to focus on loss avoidance. And why is that? In most market environments, we receive dividends or our coupon payments, but capital appreciation is usually going to be more limited. But the downside can be much larger should a company's financial performance deteriorate. So our research perspective focuses on the downside risk of every security before it's purchased for a client's portfolio. Our goal is to ensure that we are always well compensated for the risk that we're taking with our clients' money. All right, so preferred market changes. We're just taking a look at where the preferred market is today versus where it stands relative to history. And on the left side of the slide, you can see that the index spread has moved north of the long-term average that happened in 2022. It remains there today. So when you combine this spread level with today's higher interest rates, you get a yield to worst of about 7.7% and a yield to maturity of about 8% on the index. You get slightly more than that on the John Hancock preferred income ETF. And we just think that these all-in yields from an index perspective and from the perspective of our ETF are very attractive. In fact, if you look at the average yield to maturity for the index of the past 10 years, we're sitting about 250 basis points higher right now. So again, a pretty high yield. Looking in the middle of this slide, you can see index performance on a year-to-date basis through the second quarter, as well as through today. Performance is positive, and that's driven by the high income of preferreds, as price is actually down very slightly for the index year to date, just due to rates moving higher. And then on the right, you can see that new issuance has slowed as issuers have deferred that sort of activity. We're in a higher interest rate environment. And we think that, again, that highlights that the asset class is trading at an attractive level. So I can stop there and see if you have any more questions to me.
Yeah, absolutely, James. So you showed us the performance year to date, but I know a lot of people who are watching, they're thinking, yeah, preferred sound compelling, but what type of returns have they delivered historically?
Yeah, so last 10-year returns for preferreds through the second quarter of this year, slightly higher than 4%. And that includes that period, right, over the past couple of years where we've seen a material increase in interest rates. And that return level is higher than for all other categories of fixed income, including high yield bonds. High yield bonds have returned about 4%, prefers a little bit more than that. And then you have treasuries, investment grade bonds, global investment grade bonds, emerging market bonds. They have all returned less than 2%. So preferreds have had less volatility as measured by standard deviation than high yield bonds and emerging market bonds, and then higher volatility than the other bond categories I just mentioned, which is typical. You will see preferreds have volatility more in line with equities through the cycle. Now, those are historical returns. As we all know, historical returns are not always the best guide for forward returns. And we believe that is the case now, as the preferred market has pretty attractive valuations. And a potential catalyst for unlocking the attractive returns, we believe, is a Fed pause. So if we go ahead and move to the next slide, we'll take a look at historical Fed pauses, and how preferreds performed following. And as you can see on this slide, the performance of preferreds in the year following a Fed pause is strong. We've inked up an average of 14.6% in the next 12 months, looking at the past 4 rate hike cycles. And interestingly, there's actually uniformity of positive returns across all the time frames: 3 months, 6 months, 9 months, and 12 months. The average performance of preferreds has also outperformed high yield and global bonds as well. So what's going on here? At a high level, we think that this makes sense. Preferred securities are going to have some interest rate sensitivity, and they especially should in this cycle, given the meaningful discount to par that the index currently trades at. As well, the high credit quality of the companies that issue preferreds help them to provide buffer going into a potentially weaker economic environment, which can sometimes coincide or following a rate hiking cycle. And before we move on, just let me circle back to that point I just made about preferred securities trading at a discount to par. This is actually fairly unusual, and it's a point that should be highlighted. The index today is trading about 86 cents on the dollar. So this means that should rates move lower, or spreads move lower, or both rates and spreads move lower, preferreds can experience material capital appreciation. And that's not much different than what you would experience with investment grade in an environment where interest rates decline.
So James, you've talked about obviously the Fed pause and how that could be beneficial for preferreds, but obviously for the last year or two, the concern has been rising interest rates, and we're seeing obviously the 10-year, 30-year hitting new highs as we speak. What characteristics do preferred securities have that help them perform well in a potentially rising rate environment?
Yeah, great question. So while preferreds generally have 30 plus year maturities or no maturity date at all, preferreds duration is generally lower, and that's because most become callable 5 or 10 years after they're issued. Most preferreds transition to a floating rate at those call periods that are 5 or 10 years out. So nearly all of the $1,000 par institutional market preferreds have this fixed to floating rate structure, while a minority of the $25 par are fixed to float. So that fixed to floating structure appeals because it reduces interest rate risk. If rates rise, as they have, and the security remains outstanding, then you will receive higher distributions where the security could be called away. And we then get the principal back, and we're able to invest it again into a higher interest rate environment. So that's something that we're benefiting from on a number of securities within the portfolio today. Hope that answers your question.
Absolutely.
All right. I think that wraps it up for me. I'll pass it over to you, Joe.
Great. Well, thanks, James. And thank you, everyone, for listening in today. So James gave a great overview of the preferred market and why invest in preferreds. But I'm going to talk about why invest in the John Hancock Preferred Income ETF. But first, let me give a brief introduction of myself. So my name is Joe Bozoyan. I'm the lead portfolio manager. I've been on this strategy since 2015. I've been in the investments business for over 30 years now. I started my career back in 1994 as a corporate bond analyst at Sun Life Financial here in the Boston area as well. After 4 years as a corporate bond analyst, I moved over to the equity side of things. And I was an equity analyst for 17 years, working at a few different shops, including Evergreen Investments here in Boston as well, before I was asked to become a portfolio manager on the preferred income team. So I followed the energy and utility sectors continuously throughout my career. So I have a lot of experience covering these sectors. And we'll talk about that more later, but these are sectors we really like for our portfolios. I believe my background actually matches very well with being a preferred portfolio manager, given that preferreds are considered hybrid securities and that have both characteristics of equities and fixed income. But moving to the slide, we talk about philosophy and process. So in terms of philosophy, we have three main goals for our preferred portfolios. Number one, generating a high level of current income. Two, preservation of capital. And three, total return potential. To help us achieve those goals, we look for five elements in the issuers in which we invest our clients' assets. So number one, we look for companies with enduring or long-lasting business models. These are companies that have been around for decades and will be around for decades to come. Examples are large cap banks and utilities. Number two, strong balance sheets. And this is a really important part of our process. In fact, over 50% of our holdings are investment grade. And senior unsecured ratings from these issuers in our portfolios are over 80% investment grade rated. So really strong balance sheets. Number three, sustainable free cash flow. We like companies that generate a lot of cash, so they have ample cash flows to pay their preferred dividends. Four, stable and or growing common dividends. And then finally, solid management teams with track records of delivering strong performance. We do this by leveraging Manulife's extensive network of portfolio managers, analysts, our traders, and ESG team members, all located around the globe. We believe that by leveraging these teams, we can develop an information advantage versus the market and our peers. We further believe that mispriced securities always exist, that fundamental research is the best method for uncovering these opportunities. Having flexibility to move up and down a company's capital structure increases the number of ways we can add value for our clients. And embedding ESG and other risk management considerations throughout the process is critical to our ability to deliver attractive, risk-adjusted returns for our clients. So our investment process largely falls into the three steps as illustrated on the bottom of this page. Number one, identifying attractive regions and sectors. Two, engage in intensive fundamental research to inform security selection. And then three, portfolio construction and risk management. Then if you move on to the next slide. And this slide really shows one of our biggest areas of differentiation versus our peers. So unlike ETFs and some competitors that only invest in one area of the preferred market, we can invest in all areas of preferreds. And we're able to trade and take advantage of the dislocations that sometimes occur in the preferred marketplace. Again, this is the major advantage of active portfolio management. As you can see from the slide, there are four major areas of the preferred market: retail preferreds, convertible preferreds, long-dated senior bonds, sometimes referred to as baby bonds, and institutional preferreds. Retail preferreds are tailored for the retail investor and trade in $25 par increments. Retail investors gain access to this part of the preferred market primarily from owning preferred ETFs. Long-term retail preferreds have performed very well. However, they do tend to be more volatile, mainly because retail investors tend to be more short-sighted than institutional investors, and are more likely to sell when they fear a market downturn. These securities also tend to be fixed for life securities, so they are more interest rate sensitive. Another part of the preferred market that we invest is convertible preferreds. These are preferreds that convert to equity, usually in 3 years' time. We particularly like convertible preferreds issued by utilities, since the coupons offered by these securities are very attractive. We do tend to sell the security before it converts to equity, though. Another area of the preferred market that we invest is long-dated senior unsecured bonds. They're also tailored for the retail investor. These senior unsecured bonds trade in $25 par increments like retail preferreds, but are higher up in the capital structure of a company and therefore have higher credit ratings. Finally, there are the institutional preferreds. These securities tend to be more stable since they are in institutional investors' hands. In addition to being more stable, the majority of institutional preferreds are fixed to floating rate securities, which help protect against a rapid rise in interest rates. Again, this is where active management can really add to performance by taking advantage of dislocations that happen from time to time in these different segments. There have been some time periods where some really strong, high-quality companies have gone on sale. An example would be in early 2020, as the pandemic unfolded. Very high quality company preferreds, particularly retail preferreds, were down in some cases 20% in a matter of days. The market was indiscriminate in its selling, and even high quality defensive utilities sold off. So this was a fabulous buying opportunity that we were able to take advantage of, which resulted in outperformance in those securities we bought. Again, this is the benefit of active management, being able to take advantages of these opportunities when they arise, something passive ETFs cannot do. So the next few slides, I'm going to go through, go into more depth in terms of why we're different or how we're different. On this next slide, you can see that how we're positioned from a sector standpoint and how it differs from the market. Financial services, including insurance, makes up close to 75% of the preferred market. We're quite different than our peers, particularly in our significant weighting to the utility sector. Our favorable view of the utility sector naturally results in our being underweight the banking sector. So I'll go into more detail on why utilities, but we like their long-term fundamentals plus their defensive characteristics. You can see that we're underweight banks, but even within the banking sector, the names we own, we are overweight the larger cap banks and underweight smaller regional banks, which leads me to my next slide. So in the previous page, I showed that we are fairly significantly underweight banks and overweight the utility sector. This slide really breaks down where our exposure lies in the banking sector. On the left half of the slide, we show net interest income and net interest margin over time for the banks in the U.S. You can see interest rates moved up over the last 12 months, obviously, and their net interest margin has moved up fairly significantly as well. There has been talk about banks' margins being squeezed because of having to pay more for deposits. People forget that they are making considerably more now than they were 2 years ago when rates were much lower. So there is a cushion there so that even if net interest margin goes down, it is still likely to be higher than it was 2 years ago. And as you can see on the slide, the majority of our exposure is in the large money center banks, the so-called SIFIs, or systematically important financial institutions. So these are the Bank of Americas, the JP Morgans, and the Citigroups of the world. They were deemed too big to fail. As a result, these banks have more stringent capital requirements than smaller banks. These banks have very good balance sheets and high levels of capital, which enables them to withstand a crisis. That is why we saw these banks actually benefit from the downfall of Silicon Valley Bank and First Republic Bank by gaining more deposits and therefore more business. You can see that these banks represent the majority of our bank holdings. Super regional banks are the next tier down from SIFIs, but effectively operate like them with very high levels of capital. Banks in this cohort are the PNCs and the U.S. Bancorps of the world. These banks have very strong credit ratings as well, and have also benefited from the turmoil caused by Silicon Valley Bank. So we do have a small weighting in a few regional banks. Regional banks do have more exposure to commercial real estate, so it is something we are watching very closely. The type of real estate they have exposure to, though, is quite different than larger banks or investment funds. So these banks typically have exposure to office buildings that house the yoga studio or the local accountant, so not large office buildings. So we have heavily scrutinized our bank exposure, though, and we're lucky to have many experienced analysts at Manulife who have followed the sector for many years. Our bank analysts believe our holdings are solid, and we are very comfortable holding them. So we do have a little exposure to the European banks who are like SIFIs in the countries where they're domiciled. We tend to prefer U.S. banks, though, since the structures are different in Europe. The structures there are different in that regulators can choose to convert to equity or simply wipe out these bonds if capital levels go below a certain threshold. Again, we saw this happen back in March when Credit Suisse, when Swiss regulators there completely wiped out their preferreds. And this is why we typically prefer U.S. banks, because we believe in many cases we're not being compensated for taking on that risk. Finally, we do own a few Canadian banks. The Canadian banking sector isn't as competitive as in the U.S. It has far fewer banks. As a result, these banks tend to be very large, and most are very conservatively run. Then you can see at the bottom of the slide, we do have a small exposure to some of the credit card issuers as well. But on the next slide, we do go into more detail on why we love the utility sector, though. But maybe I'll stop here and see if there are any questions.
Yeah.
Well, thanks, James. And thank you, everyone, for listening in today. So James gave a great overview of the preferred market and why it invests in preferreds. But I'm going to talk about why.
Absolutely. This is really interesting stuff, Joe. So obviously, the regional banking crisis is arguably the biggest crisis that investors have had to face this year. Could you take us back to that period? How are you evaluating adding new positions as well as stress testing existing positions during that time?
Sure. Yeah, it was definitely a tough period for the marketplace at the time, and particularly in the preferred market. But this is really a big team effort for us. All hands were on deck during this time. The first thing we did was to review and analyze all of our bank preferred holdings. We looked for companies that had a lot of exposure to corporate accounts, particularly tech companies, which is really what undid Silicon Valley Bank Corp. Next, we looked to see which of our bank holdings had a lot of exposure to deposits that were greater than $250,000, so not FDIC insured, so they were more likely to kind of lose those deposits. We then looked at their capital levels and also how credit was trending. Finally, we looked at levels of commercial real estate. As shown, most of our exposure is to larger banks that are very solid from a balance sheet perspective. We did, however, swap out of a few of our smaller regional banks into larger regionals that had less exposure to commercial real estate and better balance sheets. And we just thought that this was a prudent trade, given that the whole preferred market had fallen, so you could actually do that swap without giving up that much yield. During this time, we were also buying aggressively utility preferreds that were also getting beaten up along with the whole preferred market. Again, if we thought this was a great opportunity, again, to buy some really high quality companies that are defensive investments at some great prices. So basically, we were taking advantage of that indiscriminate selling that was happening at the time by buying utility preferreds on sale and upgrading our bank preferreds by swapping out of some of the smaller regional bank holdings into larger regionals. Hope that answers your question, Sumit. Thank you. I'll move on to the next slide. And this slide is really a great illustration of why we're so excited about the utility sector. Utilities are leading the transition to renewable energy in the US. And they're doing so by aggressively shifting their generation portfolio away from coal and into wind and solar. You can see from the slide how much the utilities still need to spend to hit their renewable goals. U.S. utilities are regulated, and they get regulated rates of return on the investments that they make. So the more they spend, the more their earnings and cash flows grow. Just this transition is still in the fairly early innings, U.S. utilities have very visible earnings and cash flow growth for at least 10 years, which make for very compelling investments. In fact, as you can see on the slide, the opportunity is expected to be $4 trillion. Some of our larger holdings are heavily exposed to this renewables theme. NextEra Energy, based in Florida, is a significant holding for us. It's actually the leading renewable energy developer in the U.S. and also operates utility. NextEra is not only a major developer of wind and solar, but also is on the forefront of developing hydrogen burning generation, which has market potential. It's not only the generation of renewable energy, but also there needs to be significant capital spent on hooking up these generation plants to end customers, which means more investment in transmission and distribution. So we like utilities not only for their growth profile, but also because they are defensive investments owing to the regulated nature of their business. Maybe I'll stop there for any other questions.
Yeah, so obviously, huge opportunity in the energy transition, as you alluded to, Joe. But my question is, ultimately, preferred securities are stock, but they're not common stock, which tends to rise significantly if a company has really good prospects. That said, can preferred stocks also benefit from the growth potential of a company or an industry? And if so, how do you best structure an investment in a preferred security such that you can participate in that growth?
Sure. Yeah, that's a good question. So, I mean, obviously, ideally, we'd like to have equity participation in the company through a convertible preferred to take advantage of their growth potential. And you will see us do that with utilities that have convertible preferreds outstanding. An example, again, is NextEra Energy. They have a convert outstanding that we like. NextEra owns and operates Florida Power and Light, which is a very well-managed utility in Florida. Florida is a high-growth state, which is a positive for the utility. But as I mentioned before, it's also a leading renewable energy developer in the U.S., which combined with their regulated utility, FPL, makes a high-growth utility. So probably we think that growth lasts for years to come. We also own their preferreds as well, because NextEra is a fundamentally very strong company that has predictable cash flow growth for years to come. So we feel very good about owning their preferreds too. A strong equity valuation really usually results in a solid credit rating as well, as since these companies are able to issue equity to fund CapEx and also to use that money to pay down debt. So to answer your question, the best way to participate is to own the convertible preferred. However, owning a fundamentally strong company that is growing, we believe we can benefit from owning the preferreds as well. So moving on to the next slide. Thank you. On this slide, we really show how we have made portfolio shifts since the inception of this fund. Again, this is something that most ETFs cannot do. You can see how we made a fairly significant shift out of convertible preferreds into straight preferreds starting in early 2022. Most of our convertible preferreds were issued by utilities. At the time, utility equity valuations were trading at a historically high premium to the S&P 500. And one of the reasons why we like the utility convertible preferreds is because they offered very attractive yields, quite a bit more than what we were getting from straight preferreds. As the utility converts outperformed, there was very little yield advantage over straight preferreds. So we were aggressively selling these securities, which reduced equity volatility. We did this by not having to give up any yield. And this trade contributed to our outperformance last year. More recently, we've been increasing our exposure to fixed for life securities after having been overweight fixed and floating rate securities last year. We do believe we are close to a peak in interest rates and believe over time, interest rates will start to come back down again. And these fixed for life securities will outperform in a scenario where rates do come down. It's also positive for owning these securities that they do tend to be trading at big discounts to par, meaning there is upside potential in many of these securities. Again, this is something that differentiates us from our competition, the ability to take advantage of opportunities in the different parts of the preferred market. And more to this point, on the next slide, here we show how we've managed duration since the inception of the fund. You can see we've significantly increased the duration of the portfolio starting in the second half of last year. Our duration was quite low going into 2022. This was because we were anticipating interest rates to rise, so we wanted to have our duration very low. As it became evident to us that rates where we thought near a peak, we started to increase duration of our portfolios, which is illustrated on this slide. We've been doing this by increasing our weighting to fixed for life securities, trading at discounts to par value. These securities are trading at, in some cases, 20 to 25% discounts to par. These securities upside potential when rates do start to come down. So I think the important takeaway from this slide is that we do have levers to pull and moves to make to manage duration. On the next slide, I'm going to go into more detail on the characteristics of our portfolio. On this slide, you can see on the left that you can see the comparison between JHPI and our benchmark, the ICE Bank of America U.S. All Capital Securities Index. You can see that we compare very favorably from a yield standpoint relative to the benchmark, with a yield to maturity of 8.2% and yield to worst of 7.74%. Importantly, we're not taking on more credit risk to achieve this level of yield, with our average credit ratings very similar to the benchmark. You can also see we are somewhat underweight duration versus our benchmark. So we are still working on getting our duration a bit higher. Again, we're doing this in a prudent manner. We do realize in the short term, rates can move higher. We do believe longer term, the rates will start to come down, and so we will continue to move our duration higher as well. Below the yield metrics on this slide, we show the breakdown of different structures of preferreds that we own. And then finally, moving to the right side of the slide, we do show our top 10 issuers. You can see that it is quite diverse with 3 utility issuers in the top 10 and 1 energy name. Maybe I'll stop there for another question.
Yeah, so obviously huge opportunity in the energy transition, as you alluded to, Joe. But my question is, ultimately, preferred securities are stock, Joe, so quite a diverse set of issuers there. Earlier, you talked about how there's several different types of preferred securities, and 2 of them that you mentioned were retail and institutional. Is one type better than the other, or should investors have both in a portfolio?
Sure, I know it's a little confusing when I talk about these different parts of the preferred market. I did talk about these differences earlier. One thing I should point out, though, is that these companies, particularly large cap banks, can issue preferreds in both the institutional and the retail market. So regardless of whether they are institutional preferred or retail preferreds, they sit in exactly in the same place of company's capital structure. So one doesn't have the priority of the other over the other. That is why when we see significant differences in yield between the two, we view this as a very attractive buying opportunity. It's beneficial to have access to both, we think. Institutional preferreds are mostly fixed to floating rate securities and are less volatile. So in periods of rising rates, these types of preferreds tend to outperform, which played out last year. Over the long term, retail preferreds have performed very well, though, driven by retail investors' demand for yield. In addition, many retail preferreds, as I mentioned, are fixed for life, which outperform in an environment when rates do come down. So there is a benefit to owning both, and active portfolio management can result in portfolio shifts into one or the other, whichever is most attractive, which also could be an alpha generator. Any other questions, Sumit?
Yeah, that's great, Joe. And of course, another type of preferred that you've talked about are convertibles. And we talked about that when you mentioned that they help you participate in the upside of a company or an industry. Are there any other ways in which they enhance the portfolio?
Sure. Yeah, so convertible preferreds at times are great to have in a preferred portfolio. Again, most of the convertible preferreds we have owned have been in the utility space, so defensive investments. And obviously, this is an area that we have a lot of expertise in. When looking at convertible preferreds, you do need to have an opinion on the company's common stock. Again, given our knowledge of this sector, we believe we have a good sense of utility equity valuations. These securities were actually significant contributors to our performance last year. In addition, because these securities are so liquid, we can go in and out of them fairly easily. It's almost like a common stock, actually. So these convertibles have been great for our portfolios because of the extra yield they offer, the outperformance we have been able to get out of them, and the addition of the liquidity they offer. So they've been a good enhancer for our portfolios.
Obviously, everyone watching this webinar, they're familiar with ETFs, and that's typically how they get exposure to the markets. So I want to ask, when evaluating preferred stock ETFs, what should investors look for?
It's a great question. Because not all preferred funds are the same. They all have different risk profiles, so you really have to be careful of what kind of preferred fund you're buying. So you need to look at the company's prospectus, or the fund's prospectus. For example, some preferred funds only invest in institutional preferreds, which are almost all fixed to floating rate securities, as I mentioned. Other funds have a lot of exposure to European banks, which are contingent convertible securities and are more risky securities versus U.S. bank preferreds. Some have very little diversification, with mostly bank preferreds. And then finally, invest in only retail preferreds, which are mostly fixed for life securities and do tend to be more volatile. And then finally, some have high yield bonds in them as well, which can lower the quality of the portfolio. So, with our ETF, you don't have to worry about making those decisions. We can buy fixed to floating rate securities if rates are rising, and can conversely go overweight fixed for life if we think rates will fall. Our portfolio is significantly more diversified and has a defensive bent with an overweight to the utility sector as well. So you don't have to worry about an outsized exposure to the financial services sector. So we manage a diversified, high-quality portfolio that has the flexibility to invest in all types of preferreds, which enables us to perform well in any economic environment. So you really need to look under the hood at these different preferred ETFs and be comfortable with the different risk profiles of each of these funds out there.
Well, that makes a ton of sense. Why don't we move over to the final slides now, Joe, and you can wrap us up.
So finally, on this slide, we show our outlook. So we're very bullish preferred securities, and we believe their yields offer great value here. The Fed has significantly increased the Fed funds rate in a relatively short period of time, and the impact of this tightening is still filtering through our economy. We believe we will see earnings and balance sheets negatively impacted by this, particularly as companies have to refinance their debt at much higher interest rates. So there's really the lower quality companies that have a lot of debt that will be the most negatively impacted, with high quality companies that have strong balance sheets able to withstand the softening conditions. And these are the companies that mostly make up the preferred market. It's important to remember that preferreds are issued mostly by investment grade, high quality companies. Given our view on the economy softening over time, we believe we're close to a peak in interest rates. Preferred yields are very attractive and compare favorably from a yield standpoint to high yield bonds, will also appreciate in value as rates come down. In addition, preferred credit spreads remain wide from an historical perspective, partially due to the pressure the sector underwent in March of this year when Silicon Valley Bank failed. And unlike passive ETFs, we have tools in our toolbox that can help us navigate a softening landscape. In fact, our portfolio is defensively positioned now with an overweight to electric and gas utilities and an overweight to SIFI banks. And then finally, on this next slide, I just want to leave you with why invest in JHPI. Number one, we have a very experienced management team as one of the larger preferred investors in the market. Two, we have the flexibility to invest across the spectrum of preferred securities. We can invest in the most attractive opportunities across the preferred universe, including retail preferreds, institutional preferreds, and convertibles. And then finally, we have a more diversified portfolio versus our peers and the benchmark, with an emphasis on the defensive utility sector.
Fantastic. We're going to have to leave it there. Joe, James, it's been an absolute pleasure. Thanks so much for sharing your insights with us.
Sure. Thanks.
And a big thank you to everyone tuning in today. A replay of this webinar will be available on demand in the Media Center section of the ETF.com website. Have a great day and see you next time.